Nick Suee, who is also a deep and rigorous thinker, especially in the investment area. I was very impressed when he recently challenged Mark Carney publicly that his 3 R's. I think the R stands for return, reporting, risk, and return. And he challenged Mark Carney on his assertion in his Reef lecture that the 3 R's are not good enough. In fact, if I were to read correctly his article, he said it was not only flawed, but was actually dangerous. Yeah. Coming back to his, and I hope that he could repeat some of his arguments later on, and I believe he will. But his current position is he is the founder or chair of 3 initiatives organization: Climate Bonds, Radix, and also Kellen Consulting. And he pursued a wide variety of things. He was involved in City Business School, and he has worked with the UN, World Bank, and 30 countries. And he was also been awarded by the IFoA as well as the Fiatus Reward for his charitable efforts. And he's an author of a book called Finance, Society, and Sustainability. So with this, I introduce you, Nick Silva.
Thank you very much, Suee Chieh. You're very kind. And I've come up with the 3 S's, as opposed, which I'll talk about a bit later. Well, these are such big and difficult issues, and I've having to follow Nico, Ashok, and Lucy, such inspiring speakers. And first thing in the morning, this is a really hard. So I wanted to take up the challenge to the profession that Paul Collier and John Chieh set out over the last couple of days. I'm going to focus on pensions in the UK. I mean, similar themes apply to other fields and other countries that we work in. In my work at Kellen Consulting, I look at country level pension systems. And if you boil it down, a pension system invests savings in a way that the economy can generate returns that can then pay back its pensions when they come due. And if I look at the UK objectively, we're doing a pretty rubbish job, really. Most of our pensions assets, I have down here 2.5 trillion, Ashok had a bigger number, are sat in zombie defined benefit schemes earning 0% returns in government bonds. I exaggerate, but only a bit. And whilst you have a minority of older people with gold-plated pensions, for younger people, a decent level of pension is basically unaffordable. If I were tasked with designing a sustainable pension system, I would not start from here. An analysis of the dysfunction of public capital markets, and John Chieh, who spoke here on Tuesday, has written a lot about this, always start with public companies being subject to the tyranny of quarterly reporting cycles, making them take short-term decisions at the expense of long-term investment, something that Ashok talked to. And this is reinforced by senior management being compensated in relation to their company's share price. And they therefore incentivize to engage in activity which can be damaging, unsustainable, and not necessarily in the long-term interests of the companies themselves. Examples of things like loading the company up with debt and then returning money to shareholders, reducing costs by putting staff on low-pay, zero-hour contracts, lobbying governments to weaken regulation on things like carbon emissions and pollution, and avoiding tax, etc., etc. The quarterly reporting cycle is driven by investors who compete on quarterly returns. And why do they do this? Well, we actuaries set mandates for investors based on these metrics. John Chieh convincingly argues that the fund management industry only adds value as a whole, not by competing against each other on returns, which, as Ashok said, is a zero-sum game, but by wisely stewarding the companies which they own. Yet most investment managers see this activity as a waste of time and dedicate very little resources to it. Now, I appreciate that mandates nowadays are much more complex than just monitoring quarterly returns, but it is safe to say that not many or any make stewardship their top priority, which John Chieh would argue is what they should be doing. Now, we actuaries also set the asset allocation of a large chunk of our society's assets, as Ashok also mentioned, and these are almost entirely invested in financial assets. So, for example, the stock market returns money to shareholders rather than invests it. Only a tiny proportion of institutional investment goes to infrastructure or small growing companies or to R&D. Yet, as Paul Collier called us out for yesterday, it's this investment that a country needs to be able to pay back its pensions in the future and also to move towards a zero carbon sustainable economy. Why is this? Well, regulation is based on the fallacy of composition. It makes the false assumption that pension funds and other institutional investors optimizing their own risk return, and which therefore causes them to prioritize liquid financial assets, will ensure an optimal outcome for the system as a whole. But for the system as a whole to function properly, the economy has to generate returns, which requires real investment. So real investment needs to be preference over financial assets. The reduction in real asset allocation and the adoption of shareholder maximization coincided with actuaries changing our methods in adopting mark-to-market solvency valuations. And this was no coincidence, because this is the result of the supremacy of financial economic theory, the very same theory that John Kay, Paul Collier, Mervyn King says doesn't work. We actuaries made a conscious decision to adopt this methodology, and I strongly feel that this has inadvertently damaged society by reducing investment in real assets and incentivizing companies to make short-term decisions and pass on externalities to society. You could argue that we are forced to act in this way by regulation, but regulation is itself heavily influenced by dominant economic theories and professional practice. So what do? It's not individual actuaries that can do anything by themselves, but collectively we can. Kay argued that the defined benefit schemes have been regulated out of existence, and this was because of a lot of short-term policy mistakes made by successive governments. But this is not surprising, because pensions are highly complex and governments don't have the expertise. They are not qualified to make decisions on pensions policy, but we are the experts. We should be telling them what to do. A lot of actuaries currently earn their living from advising defined benefit schemes, but defined benefit schemes are dying out. This work will not last forever. Surely we should be utilising our skills to develop a sustainable long-term solution for pensions. From society's point of view, our valuable skills and expertise we have built up over many years are being wasted. As a first step, I propose that the IFoA commission a high-profile prize competition for proposals for a sustainable pension system. Entries should be judged on how they achieve certain objectives, which I term the 3 S's: the sharing of risk equitably, sustainable investment which generates returns while achieving social goals like decarbonisation and levelling up, and looking at the system as a whole, which needs to be resilient. Also, I couldn't fit in the 4th S, which is stewardship, which I talked about before. In the COVID crisis, we often hear that policy should be guided by the science. We are facing a long-term pensions crisis of our own making. So why is pensions policy not being guided by actuarial science? And that it is not is our fault. As Paul Collier said yesterday, we need to stick our heads over the parapet. So thank you very much for listening to me. And I've also been following the excellent questions which have been asked, so I look forward to discussing them later.
Thank you very much, Nick, for the practical suggestions for actuaries, right? But if I were an actuary, I would be concerned about the context which I'm operating in, and see how well that will fall into my circumstance, because you do require some degree of reciprocity and neutrality. You can't do it on your own. But that, put that aside. But I'm also curious that we have been talking about financial theory, pricing, and public interest, and there seems to be a discussion that if you could fix the economic theory to wider measure, all will be well. And I wanted maybe people to reflect on this. Whether are there other societies which are doing this well, where the CEO pay and pursuit of personal self-interest is not so excessive, but no society is perfect. Or has UK and US, what I call the Anglo-Saxon society, it has overswung, yeah. Whereas European nations may have less of this issue, but their issues could be other types of issues. So I want you to hold that space. And before I go to the question, the other thing which I want speakers to, panelists to think about, maybe 2 or 3 practical ideas towards the end, which you could think IFoA could do to help carry the conversation forward.